남자들은 탐탐탐 내 입술 냠냠냠 어디 가도 탕탕탕 등장은 짜짜짜 뛰자 팡팡팡 디스코 팡팡팡 헬로 엉덩이 빵빵빵 남자들은 탐탐탐 내 입술 냠냠냠 어디 가도 탕탕탕 등장은 짜짜짜 뛰자 팡팡팡 등장은 짜짜짜 뛰자 팡팡팡 디스코
Assalamualaikum and good morning everyone.
Waalaikumsalam, Ms. Syamimi.
First, I would like to thank all of you for joining this meeting. Our focus today is to address liquidity challenges and propose a key strategy for improvement, which everyone will provide one solution. May I start my presentation?
Yeah, sure.
Okay, based on the data collected for year 2023, our current ratio is 2.15 rather than 1.64, indicating from our short-term liability coverage, while our quick is 1.23 compared to 2022, which was 0.93, showing our company has less dependency on inventory for liquidity. Despite improvement, inventory level remain high, tying up cash. So let's hear from our cash manager. What is your opinion?
Thank you, Mrs. Syamimi, for the opportunity. As for your understanding, your cash reserve increased to 46,000 ringgit in 2023, but our delayed receivables and rising inventory has created cash flow strain. So, my recommendation from cash management department is we should align inventory purchases with sales forecasts in order to avoid overstocking and free up cash. Now, over to the accounts receivable manager.
Yeah, thank you, Mr. Akmal. Let me explain my point. For your information, our DSO or Days Sales Outstanding has improved from 34.07 days to 20.69 days. However, delayed payments from some customers still become an issue. So my recommendation is we can introduce early payment discounts to encourage quicker collections and improve our company cash inflows. I will now hand it over to the Investor Relations Officer.
Thank you, Mr. Irfan. For IR department, our role is we need to maintain our investor confidence while addressing liquidity. As for that, my recommendation is to host a stakeholder webinar to share our liquidity strategy, which emphasize improved ratio and proactive measures like inventory and receivable management. As a result, it will build trust and showcase our commitment to growth. That's all from me.
Okay, to summarize, we can conclude our strategy to align inventory purchases with sales forecasts, introduce early payment discount to accelerate collections, communicate transparently with stakeholders via a webinar. Let's implement this action immediately and review progress next month. Any final comments?
No.
I think there's no.
Okay, I think that's all from today. So you guys may leave.
Okay, thank you.
Thank you.
Thank you.
Good morning, team. Today we will analyze our leverage ratios and determine their implication on our company financial stability. Our debt to equity ratio is 1.31 in 2022, indicating a high reliance on debt compared to equity, while for 2023 is 1.24, showing a slight improvement but still showing significant reliance on debt. For debt to asset ratio for 2022 is 0.55, meaning 55% of our assets were financed through debt, while for 2023 it is 0.51, which was a reduction, which reflects our better financial management. For interest coverage ratio in 2022, we recorded 4.4 times, expressing our moderate ability to cover interest expenses. For year 2023, it is improved to 10 times, which was a substantial improvement, showing we have stronger earnings to cover interest payment. We see progress in 2023, but we must remain cautious. So let's hear from Ms. Kuratu.
Thank you, Ms. Syamimi. As in my own view, why our debt to equity ratio and debt to asset ratio improved slightly in 2023, it's still showing moderate financial risk. As for your information, high leverage can limit our ability to adapt to unexpected challenges like market downturns. However, the significant improvement in the interest coverage ratio from 4.4 to 10 times indicates that we have enhanced our ability to meet interest obligation, reducing immediate financial risk. So, my recommendation is to refinance some of our long-term debt at lower interest rates to capitalize on our improved earnings and further reduce financial strain. As a result, this will lower borrowing costs, improve cash flow, and provide more flexibility for future investment. Over to finance analyze.
Thank you, Ms. Kuratu. Based on the analysis, we have improvement in the debt to equity ratio and debt to assets ratio, which illustrate that we have healthier financial management. The jump in the interest coverage ratio to 10 times is particularly encouraging. So, I would recommend that we should take advantage of this strong position to cautiously finance targeted growth projects. For example, investing in a premium skincare line with natural ingredients could boost profitability and market share. By financing high return projects, we can balance growth and with manageable financial risks, leveraging our improved financial position. Now to the operations manager, Mr. Irfan.
Thank you for the opportunity, Mr. Akmal. In my opinion, as an operations manager, additional debt could help us scale our business. For example, by upgrading production facilities for cost efficiency and expand our business into an online customizable makeup platform in order to tap into new customer segments, especially youth. However, over-reliance on debt might strain our business future operations if market conditions become worse. My recommendation is to prioritize high return of investment projects like the customizable makeup platform, which require minimal debt but have the potential to significantly boost our revenue. As a result, this targeted approach will enhance operational efficiency and profitability while maintaining our financial stability. So back to the Chief Finance Officer.
Thank you, Mr. Ibai. To summarize, our first strategy is to refinance long-term debt at lower rates to reduce costs and strengthen financial stability. Secondly, to use improved leverage methods to finance targeted growth initiatives like premium skincare products or a customizable makeup platform. Third is being focused on high ROI projects to ensure sustainable growth. This strategy will help us. Thank you, everyone. Let's implement this recommendation in the upcoming fiscal meeting.
Thank you, Ms. Syamimi.
Good morning, everyone. Thank you for joining this important discussion on improving operational efficiency. To start, let's review our 2023 efficiency ratio. Our asset turnover is 1.46 times compared to 1.13 times in 2022. It was showing improvement but still below potential. Our inventory turnover is 8.36 times, up from 7.2 times in 2022. It was a positive sign, but we must avoid stock outs. Our receivable turnover is 15.79 times, up from 0.71 times. Our collection are faster, but we need to balance speed with maintaining a good customer relationships. Today, we'll be focused on strategy to improve this area. Let's begin with the supply chain manager.
Thank you, Ms. Syamimi. Looking at our inventory turnover, the numbers are healthy, but we are still holding more inventory than necessary, which ties up capital and storage space. This could hurt our cash flow in the long term. My recommendation is, I suggest we adopt a just-in-time, which is JIT inventory system. This will allow us to align inventory levels closely with actual sales, reducing holding costs and freeing up resources. Additionally, building up stronger relationships with our suppliers will enable faster restocking when demand spikes. This way, we can operate more efficiently and keep costs in check. I will now hand it to Ms. Aisha.
Thank you, Mr. Akmal. Now, when we look at our asset turnover, it's clearly we are not fully utilizing our asset to drive sales. This indicates an opportunity to improve how we generate revenue using our current resources. My recommendation are we should focus on targeted marketing campaigns that aim at high potential customer segment. By better understanding customer preference, we can tailor promotion and offers to boost sales. Also, introducing loyalty programs could enhance customer retention and increase repeated purchases. Retaining existing customers is often more cost-effective than acquiring new ones, and loyal customers tend to spend more over time. I think this can help us to enhance our operational efficiency.
Thank you, Ms. Aisha. Workforce productivity plays a significant role in our operation efficiency. Even with optimized inventory and strong sales campaigns, poor execution can undermine our efforts. By recommendation, this purpose, we implement training programs to upskill our employees, focusing on data analysis, customer service, and operational efficiency. Also, enhanced skill will lead to better decision-making and smoother execution of strategies. Next, introducing performance initiatives could motivate employees to consistently deliver their best work, directly impacting our efficiency ratio. I think that's all from my side.
Okay, thank you everyone. To summarize, our key actions are to optimize inventory management by adopting JIT practices and improving supplier relationships. The second one is to boost sales efficiency through targeted marketing, loyalty programs. The last one is to enhance workforce productivity with training and performance incentives. These strategies align with our goal of improving efficiency while maintaining a focus on long-term sustainability. Let's assign specific themes to each of these initiatives and set measurable milestones for the next 3 months. We will convene to assess progress and address any challenges. Does anyone have additional suggestion or concern?
No.
If not, I think that's all for this meeting. Meeting adjourned.
Okay, thank you,
Okay, thank
Ms.
you.
Mimi.
Good morning, team. Thank you again for joining our meeting. Today, we will review our profitability ratios and discuss strategies to enhance profitability for our company. May I present our data?
Yes.
Yes.
Okay. For your information, for year 2023, our gross profit margin is 23.33%, showing our effective control over production costs relative to revenue. While our net profit margin is 9%, reflect that we have higher expenses than reduced overall profitability. And our return on assets, or ROA, is 13.17%, indicating that our assets are generating moderate returns. In my opinion, as CFO, we need to focus on increasing that net profit margin while supporting growth. Let's start with marketing manager.
Thank you, Mr. Nim. And let me start. We know that our revenue increased significantly to RM 600,000 in year 2022, which drive by product promotions. However, I identify that we haven't fully capitalized on high margin opportunities. So my recommendation is we could introduce bundle promotions such as a skincare set combining our best sellers like facial serum, moisturizer and sunscreen, and launch limited edition makeup palettes for festive seasons like Hari Raya or Deepavali. This is because the strategy will boost our short-term revenue by encourage bulk purchases while create excitement around exclusive products, which foster long-term customer loyalty. Now, over to the operations manager.
Thank you, Mr. Irfan. Operational costs are slightly high due to inefficiency in production and procurement. So my recommendation is to streamline procurement by negotiating bulk discount with supplier for our new materials, such as packaging for lipstick and foundation bottles, and optimize inventory to reduce risk. As a result, this will lower production costs, improve gross profit margins, and increase overall profitability without requiring additional sales volume. So,
Thank you for opportunity, Ms. Kuratu. As we know, asset efficiency is good, but in my opinion, we can improve our returns by reducing unnecessary capital expenses. So my suggestion is to delay non-essential capital investment, such as expanding to new retail outlets, and instead focus on enhancing our existing product lines, like expanding shade in our liquid foundation series. As an impact, this will enhance liquidity, stabilize profitability, and provide funds to scale operation or develop new high-demand products later. Now back to Ms. Syamimi.
Thank you guys. To summarize, we will launch by the promotion with skincare products and limited edition makeup balance to drive sales. Secondly, we are going to streamline procurement for raw materials like lipstick and foundation packaging to reduce costs. And last suggestion is we will delay our non-critical investment, instead focus on improving current product offering like expanding foundation shades. I can summarize this strategy will strengthen our profitability while ensuring sustainable growth. Let's implement them and review progress in the next meeting. I think that's all. So you get me.
Thank you, Ms.
Ms.